Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing we want to do is open our brokerage platform. The one we use is tastytrade. You can use whatever you like, it doesn't really matter. And then you want to just go to any underlying. We can just use BA here, and you simply want to open up a list of expirations. This is what it will look like. Depending on your broker, it might look slightly different, but basically it's just going to be a list of expirations, and you want to stick to the monthly expirations, not the weeklies or quarterlies, and you want to be somewhere between 30 and 60 days out in time. So the first available monthly expiration is November 15th, which is 24 days away, which is too close. The next one out from there is December 20th, 59 days out. And that looks much more suitable for what we need to do. So now we have that information, 59 days, we can go to our watch list, simply filter out any underlying that has earnings over the next 59 days. We do not want earnings to disturb our trade. It will increase volatility. It will mess up our deltas. And both of these things will have a negative effect on our P&L. And we also want to filter out anything that has a low liquidity level. The reason for that is simply because we want to be able to get in and out of positions easily, and we don't want to be paying wide spreads. We want tight spreads. The spread is what you pay. It is the difference between the bid and ask. You pay it every time you get in, and you pay it every time you get out. The tighter the spread, the less you pay. The wider the spread, the more you pay. That's why we want to only trade liquid underlyings. So now we'll have a list of things that we can trade. We want to order everything from high to low IVR, like we've done here. And we want to stick to things that generally have an IV rank of over 30, but over 50 would be perfect. So we go down the list and keep in mind what's already in your portfolio. For example, we've got a position on GLD already. This is just simply a small account, just for test and example purposes. This is not an actual real portfolio that we manage, but we've already got a position on GLD. And if this was a real portfolio, we wouldn't, for example, look to put another position on GDXJ, because we would then be too heavily weighted in gold, for example, or precious metals. Being that we only have two positions on in this portfolio, UAL being the other one, it means that we'd be 2 parts gold, 1 part airline. It's not really ideal. What would be more efficient would be to say, have a look at bonds, or, we want to stay away from GDX. We might want to have a look at, say, crude oil. We might want to have a look at the emerging markets, and just use common sense, basically. JPM here is in the banking sector. Use common sense and you'll be fine. And I think we can actually have a look at JPM here. It's got an IV rank of 44.6, which is nice to see. It's close to 50. It's not quite at 50, but that's okay. The absolute IV level is at 25.5, and it's trading at about $224, which should give us a nice juicy premium. If we were to just have a look at the chart for JPM, JPM kind of seems to be moving with some sort of rhythm. And I think if in the worst case on a naked position, I think we should be able to manage our way out of this with not too much trouble. So if we have a look at JPM, we know we're going to be at the December 20th expiration. And now we've got the options chain here. We simply at this point want to sell one call, one put, and I like to sell them anywhere between 16 and 20 deltas out. So we've got a 16 delta here on the call side at the 245 strike, and we've got a 17 delta on the put side at the 205 strike. And this quite simply is the position that we'd be looking to put on. We'd collect $3.53 cents per share times 100 shares per contract. That's $350 we'd collect up front. Our broker is going to require just over $2,500 in buying power to open this position. That does give us a very nice return on capital trade for a naked position, especially. We get $8.50 of daily theta decay to start with. This will increase over time, assuming all else stays equal. And if price stays within this range, we keep all of the premium. Specifically, if price stays within this range, and if price is at or within this range at 59 days in time, then we will keep all this premium. And the chance of that happening is 72%. And if we didn't want to wait all the way to expiration to keep all of the premium, and we just wanted to get out at, say, 50%, then we can simply just get out at 50% and we'd have a 90% chance of success. So very, very high probabilities here. Now, the only other thing you might be thinking is that $2,500 might seem like quite a lot. So for people with smaller accounts, this is how you can manipulate positions to fit inside your portfolio. You simply just buy another contract that's slightly further out of the money. This is $5 wide. You can just come on to the put side and do the same thing over there. And what that does is it limits our loss. It limits our loss from where our short is to where our long is, which is $5. So our max loss is $5 minus the premium that we collect, which is $1.17. And that's how we arrive at our max loss here at -383. And our broker knows this, and our broker is only going to require $383 in buying power because we no longer have an unlimited loss potential. You can manipulate this further and just play around and see what kind of premium you'd like to collect. This is probably a bit of a juicier position for something like an iron condor or a covered position. This is technically called an iron condor, but by all means, you can have a play around with it. And this is how you can manipulate and find positions to fit inside your portfolio. In addition to this, you do want to keep in mind the sizing of your positions relative to your overall portfolio, because it doesn't matter what you do, eventually something will go wrong, and if your sizing is wrong, it can take you out, especially if you're using naked positions, because with naked positions, margin expands. So what we've done is we've created a spreadsheet, a position sizing template spreadsheet here, and the way it works is very simple. You enter in the size of your portfolio, you enter in what the current VIX level is, and below that, it will tell you exactly how you need to break down your portfolio. And as long as you stick to this, you'll be fine over the long term. No one thing will wipe you out as long as you're also staying diverse, of course. Again, this is free for everyone to use and get a copy of. Link is in the description. And then click on free position sizing template and it will take you to where you need to go. If you want to learn in more detail and see what we're doing behind the scenes, link in description, click on EDS Premium, get yourself signed up, and inside you'll have exclusive access to our portfolios where you'll be able to see what positions we're placing, what we're doing, how we're managing and adjusting positions. There's also a full course, so no prior knowledge is required. We will teach you everything you need to know. It's a private community, so if you get stuck, you can speak with myself directly or with other like-minded individuals. And there's also a 100% money-back guarantee. So after 6 months, once you've studied our full course and followed some of our trades, if you haven't seen results and aren't profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free on your part. And right now it is £1 a month to join. The price will be increasing. However, once you're in, the price is locked in for you. So you are rewarded for getting in early. And at the moment, I am offering complimentary one-on-one onboarding calls for the first couple of people that join. Once everything grows to a point where we've got members joining on a daily basis, then the onboarding calls will become unfeasible to do on a one-on-one basis. So take advantage of it while you can. You definitely do get rewarded for joining early. So with that being said, I will see you guys on the inside.